bounce back there, but I'm hanging on to it. I like it.
All right. Well, the latest Fed minutes indicating more rate hikes are needed to bring down inflation. And our next guest suggests that weakens the case to own stocks. Market forecaster Jim Bianco runs Bianco Research. Jim, great to have you with us. What did you think of the minutes? Did it change anything about how you think the Fed is going to proceed the next meeting?
No, the minutes were hyped because Jay Powell said February 1st that he would lay out a detailed plan for how the Fed would pause. And when we got there, we didn't really get a detailed plan, or whatever plan we got was before a monster payroll report and before an uptick in CPI, and it really doesn't apply anymore. And that set the stage for what we've seen in the last 2 weeks, and that is a big rise of interest rates. 10-year yields up 50 basis points. The street is coming out now and saying that the Fed is going to raise rates not only in March and in May, but again in June and go to 5.5%. And that is becoming more and more the reality. And the minutes didn't do anything to stop that train that were going beyond the 5.25 that the Fed was saying would be their terminal or end point just a few weeks ago.
Mm-hmm. And I guess there's also the wild card of a 50 basis point hike the next meeting. We know that at least Mester and Bullard were in favor of that at the last meeting. We don't know who else might have been also, because the language in the minutes seemed to imply that there could have been another person who is in the same camp. But I'm wondering, Jim, if we're just, we're not looking at the big picture here, whether there's 50 now or there's an additional 25, the end point is higher. But how long do you think we will be at that endpoint?
No, you're right. I think that, whether we do 50 or 25 at the next meeting is really a function of the stock market. If we're 42, 4,300, I think we do 50. If we're 4,000 where we're at now or lower, I think we do 25. But really what's important is, where's the Fed ultimately going? Are they going to just go to 550 and stop there? That's really no different than 525. But the market is starting to bet on the idea that they might go to 6% by the fall. SOFR, secured overnight financing options, which are going to place LIBOR, are seeing a gigantic rise in open interest in 6% bets, options bets, that the funds rate will be at 6% by the fall. And so a lot of people are starting to think that, no, the Fed's just not going to go one extra rate hike, but they're going to go many extra rate hikes. And they're going to keep going. And that's why I think you're starting to see the stock market wake up to it. And you've started to see short rates. The 2-year yield made a new high yesterday at 472 for the entire cycle.
Hey, Jim, so you just mentioned the stock market's starting to wake up to it. We have an S&P 500 that's gone from 4,200 to 4,000, or just below that here. And, again, we went from hard landing, soft landing, no landing, and now all of a sudden we're talking about a 6% Fed funds rate. What do you think the thing is that's actually going to shock investors this year, that are going to cause them to just kind of hit the sell button? And again, I'm not saying that the market acts well despite all of these expectations going higher and rates where they are. But is there something lurking that is going to cause investors to kind of all head for the door at the same time as it relates to a higher rate environment?
Well, that's a good question, because the market has been acting well. But one market which I think has not been acting well the last few weeks is the interest rate market. Those rates are starting to move higher. I think they're going to continue to move higher in the back of the Fed, continuing to be very hawkish. And I think investors are going to have to start thinking about the idea that we have a 5% or 6% world. And they're going to have to start thinking about the idea that for the stock market, cash is no longer trash. That was a 2-decade-old meme that doesn't apply. You get 6% in a 6-month bill by, say, the fall, you're going to get 2/3 of the long-term appreciation of the stock market with no risk at all. That is going to provide heady competition for the stock market. That could suck money away from the stock market. Cash could actually be somewhat of an alternative, where it was just a waste of time, throughout the 2010s. It's no longer that anymore.
Jim, always good to speak with you. Thank you.
Thank you.
Jim Bianco, Bianco Research. And Karen, you just made